let's turn back to page number 124 and 125. Page number 124 and 125 contains the standard entries journal. Now, in one of the first sessions that we went through, we actually introduced you to the standard entries journal. And what was its purpose? Lists all of the transactions that we are adjusting, transactions that are recurring, meaning they're going to occur each month. This is a listing of those transactions, and it has a space in each month for debits and credits. And the first month, January, as in the rest of the practice set, is done. You'll notice that the first entry is the employer's portion of FICA. That's the matching share. Okay, in January, that amount was $356.40. Okay, where did that number come from? From the payroll journal. Let's just flip back to the payroll journal that's for January, that is found on page number 120 and 121, and find the $356.40. Do you see that? That's where it came from. So where are you going to get it for February? Same place, but in the February payroll journal, okay? Let's look at the next item. The employer's portion of group insurance. Artistic Furniture, like several of the businesses we've worked with, match, pay their half, okay, just like FICA. So again, the January entry was $265.91. Where did it come from? Payroll journal. You can look back on the payroll journal and you'll see the number there, okay? Furniture depreciation. Where'd that number come from? It was a calculated number. It was probably based on straight line depreciation, right? Now, normally, if it's based on straight line, next month, in fact, if it's based on double declining balance, it would be the same, but same method, it would be the same next month, right? Right. So we could automatically assume, possibly, that February is going to be the same number as January, correct?
Possibly.
Possibly. What would have caused it to go up or down?
Well, if you disposed of any of it, or you got more.
Good, if you disposed of any of it, or if you bought more furniture, then that number will either go down if you've disposed of it and you're not going to depreciate anymore, or it's going to go up to begin depreciating the new furniture that you've just bought, correct? So we've got to know, in January, did we buy or dispose of any furniture? Well, hold your finger here and flip to page 127. 127 is what's called a statistical information sheet. It just contains supplemental data that you would need to know in order to complete the books for January, or in the next month, February. Now, if you'll notice, about halfway down, it shows fixed assets purchased this month. Where do you think that information came from? It probably came from the January cash disbursements journal. Okay? And if you'll look back on, if we did, we won't take the time right now, but if you did, you could go back to January and actually tie those purchases into a check or purchase order. Okay, so let's look down. Did we buy any furniture this month?
No.
Doesn't look like it, right? Then the next box, or the next rectangle down, says fixed assets disposed of this month. Did we dispose of any furniture? We disposed of a truck, right? No furniture, correct? And you can go ahead and write this in right now if you'd like. The depreciation for February did not change. So $37.50 goes in the debit column and the credit column next to that third entry, furniture depreciation. Okay? Let's look at the next one. Did equipment change? Well, if we turn to page 127, we bought a new mixer, didn't we? Okay? $3,020. We're going to depreciate that over 7 months, or 7 years, excuse me, which equates to 84 months. So what is our monthly depreciation? $35.95. Is that what I'm hearing? Do I hear that twice? Yeah, so, okay, so 3595. Well, we're already depreciating equipment 135.56, so we need to add that 3595 to the 135.56 to calculate what our depreciation will be in February. 171.51. Does that sound right? 171.51. Okay? Let's go to vehicle depreciation. Now, we had a little bit of activity on the vehicle, right? We didn't make any depreciation entry in January because we disposed of the vehicle that we had in January. So no depreciation in January, but what about February? Should we have depreciation now?
Yes.
Okay. How many years on a vehicle? 5 years, so that equates to 60 months. That pickup truck cost us $5,000. So we're going to take 5,000, divide it by 60. $83.33 is our depreciation in the month of February then. Okay? Okay. Our last depreciation entry is actually amortization on the leasehold improvements, correct? Okay. Now we amortized $50 last month. This month we replaced some carpet, or bought some new carpet for the front lobby, and we have 30 months remaining on the lease, so $1,000 over 30 months is $33.33. And since we were depreciating other leasehold improvements of $50 up to this point, the total amortization is just coincidentally the same as the automobile. I mentioned that it's $83.33. Okay. Now the next one is unemployment compensation tax. What happened was at the end of last year, we figured that our unemployment compensation tax was going to be around $480 for the year. So we just divided that by 12, and each month we just accumulate an additional $40 in unemployment compensation tax. So the amount is going to stay the same throughout the year of $40. Okay? That's our estimate of how much that tax will be. And finally, the last two amounts is to calculate the cost of wholesale sales and retail sales. Now, if you'll hold your finger here and turn to page 127, let me show you how it was done in January. Okay? You're going to have at least 3 fingers to do this exercise, okay? In the inventory cost calculation box down at the bottom, notice that we have 2 columns. One says number 1 WH, that stands for wholesale, and the next column says number 2 RT for retail, right? Underneath the wholesale box, it says the amount of sales in January were $9,566.30. Where did we get that number from? From the sales journal in January. So let's just turn back to the sales journal for January, which is found on page number 112 and 113. And I want you to find on page 113 the column for wholesale sales. And notice that it came straight from that journal. $9,566.30. Do you see that? While we're on that, just look at the retail sales to the right of it, $5,896. You'll see that number. If we turn back to the statistical information sheet on page 127, you'll see that number at the top of the column for number 2 retail. Do you see that? Now, underneath that, it shows percentages. How did we arrive at the 40% or 27%? What may have been based on? How about markup? Could it have been based on markup? Whatever it was, we might use that table that we had clear back, long time ago. We talked about the conversion table between markup and cost of sales. And we might have used that to arrive at these percentages. Whatever the case, our wholesale percentage cost of sales is 40%. Our retail is 27%. And that will be the same in February. Okay? So we're going to have to put the sales in there that we get from the sales journal, multiply it times those percentages, and arrive at the cost of sales. Now, if you'll flip back to the Standard Entries Journal, you will see those two numbers that are found in those two columns. You'll find the total numbers were put into the Standard Entries Journal. Okay? A little bit of an exercise going through there, isn't it? Okay? Okay, so February. That will be, you'll need to complete those, and some of the numbers we've talked about, others we haven't.